The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to the May edition of Digging into the BI, where the DC regional chapter and the Maryland chapter get together and look at the stocks that are in the latest edition of Better Investing, as well as stuff that we have found on the Better Investing website. So there are the four stocks we're going to be looking at tonight: Expeditors, Intel, H&R Block, and Alphabet, also known as Google. So let's go to our next slide and take care of some of our housekeeping. So a disclaimer, we're doing these presentations, even though we're coming up with our decision on buy, holds, and sells. These are for educational purposes only. We're not intending that there should be a recommendation that you should either buy or sell a particular stock. Any examples that we use here, either from Better Investing or from other sites, are not an endorsement of those particular products. We, as Better Investors, strongly recommend that you conduct your own analysis and research on it. But this will give you an opportunity to see how we present it, and to take a look, and to also let you know that we are recording this for future use. And to be able to find that location down at the bottom, that's a hyperlink. And we'll show you how to get the handouts here in just a moment. Let's go to our next slide. So we are Better Investing, which is an investment education organization outside of suburban Detroit. We focus on long-term investing, and both of those blue underlines are, again, hyperlinks that will take you to those locations on the Better Investing website. Keep in mind that all of us that are presenting tonight are volunteers in the Mid-Atlantic region. None of us are professional investment managers or any sort of that. We just do this because we enjoy it. So let's go to our next slide. And if you're new to GoToWebinar, you may find something like the control panel getting in your way, and you can sit there and you can take that orange arrow and you can click on that and make it smaller or collapse it, or you can take that whole thing and move it over to a different part by grabbing where the green circle is with your mouse. By default, you're muted, but we will unmute you during question time at the end. And during question time, you can also raise your hand, which is where that hand icon is. But during the course of this, you can clearly type in a question in the question box, and it may be easier for you to pull it out to take a look at it. And you can either send it to everybody or privately. Both of those work. Let's go to our next slide. Sometimes people say they have trouble hearing us. Since everyone else on the call, as we were testing things, said that we can hear each other, then it's probably on your end. But the best place to do is check your computer audio settings, and I'm showing you where you can do it with the, that's the orange, that's a purple line going up there. But the help is the red line. You can go up there and take a look at the red. And also, don't forget to be able to download the handouts. They're all in PDF. You'll see 4 completed SSGs as well as these slide decks, so you can be able to take a look at this and reread it at a later point. Let's go to our next slide. And so to be able to help you read things or see things better, up at the top, you may have it where it says you're looking at Cheryl's screen. You can zoom and make that bigger. You can also hit that screenshot, and you can take a picture of that very, very quickly. It will turn into a JPEG that you can save on your computer, wherever you store things on your own computer. But those are some of the things you can do along the way to sort of help with that. Let's go to our next slide. So why are we doing this webinar? Well, we're doing it because we want to be able to show you how to use a Better Investing magazine and the resources that come with the membership. Now, you don't have to be a member of Better Investing to be on this call. And if you click at the top one, that's a free 90-day trial to be able to get access to the same stuff that we have here. Our approach is to be able to help beginning investors and people that may be a little uncertain with their own judgment on the SSG to be able to do this. We're going to show you best practices. It's a chance for both of the chapters from the Mid-Atlantic region to get together. And we have 3 model clubs that cover the Maryland and DC chapters. And we like to be able to promote those. And if you're in your own club, we have a visit a club program. Both chapters do, and you can do it. So we're just trying to be able to get everyone in Maryland, DC, and Virginia to sort of work together if you're a long-term investor. So next slide, please. So in just over an hour, we're going to complete 4 stocks. We're going to always take the monthly stock to study, the undervalued feature, and then the other ones can come from anywhere else on the BI website or in the magazine. Tonight, they're coming from the ticker heat map and from the BI top 100, where the other 2 selections. But again, we're trying to be able to show you how to use the resources that are already part of your BI membership. Next slide. So to be able to know what's coming on out, you can go to the BI website and under Home, About, and News Releases. And up at the top, that's again a hyperlink to that exact location, but I have it highlighted in yellow where it says Welcome to Better Investing. And from there, you can come on down to Home and About News Releases. And you can see that this announcement for Alphabet and H&R Block came out on March 7th. So almost 2 months or so ago. And you can see they already have the stock presentations for June and July up there as well. So go ahead and take a look at that, and you can be able to time that for your own presentations in your club. Next slide, please. So to be able to make sure you don't miss out on any of the announcements, if you sign into BI, if you're a member, you go to My Account up there in the upper right, the red circle. From there, you can be able to look over on the left-hand side under My Account, and you're going to look for that green circle. It's the email and product subscription. From there, it will pop open to that big green box, and that's the stuff that's there. And where that arrow is pointing, that's for your local news. So if you're in the Maryland chapter, you'll get news from Maryland. And if you're in the DC regional chapter, you get that. But before you hit that Save Changes, we like you to go up to where the yellow highlight is, the BI Weekly Newsletter, and you can get some really good information from then. And if we go to the next slide, this is what comes in that weekly newsletter. It's just for members. It shows you some of the education that's coming on out from headquarters. It comes out at the close of business on Thursday. If you signed up for it and you don't see it, it's probably check your spam filter to see it's there. And they have some great stock ideas. And here's one I'm pointing out: a quality growth screen that's being done. And you can go in there and click on that hyperlink in green that says "View the stock screen," and you can see the ideas that they're recommending for you to take a look at. All of this is part of your membership. So let's go to our next slide. You can also reach out to either of the 2 chapters on Facebook. Those are the 2 locations for us. You do not have to be a member. You can share that with your friends. But whether you're in the Maryland chapter or in the DC chapter, either one of them, I usually try to put something up on the DC chapter for stuff like this. So hopefully you can sign up and share it with some of your friends. Next slide. So Cheryl, you want to tell us about what's coming up in the DC chapter?
Yes, we're having a Club Appreciation Day coming up this coming Saturday, starting at 10:30 a.m. and running to somewhere around 1 p.m. We're going to have some clubs that are celebrating anniversaries and multiples of 5s come and tell us about how they're able to keep their club going for as long as their anniversary is this time around. And also, we're looking at other clubs in the area. They're free to join us and share with us their story as well. You don't have to be on that anniversary list. And individual investors as well. Come share with us some of your success stories. So all are welcome. And there is the link on here to go online and join us at that time at the 10:30 mark. We'll start the go to meeting. No registration required. Just click on that link and you'll be connected. And we may even have a surprise education topic.
Very good. Thank you. In fact, 2 of the clubs from the club anniversary are presenting tonight.
Yes.
So anyway, let's go to our next slide. And Jonathan, I don't know if you can see this or if you want me to take it, but this is a really good example of stuff going on in the Maryland chapter.
Yeah, our chapter, we have a few things going on. If I recall, we have the stock competition that we're currently producing, and this is an upcoming webinar that we see here, the analysis of the Better Investing Top 100. This is given by Roger Cronchi. He does this every year. This is a very nice presentation where he analyzes the top 100 and the top 200 better investing stocks that are in the magazine that comes out in the April edition. So everyone is certainly welcome. You can register, and that is on May 21st, which is in a couple of weeks. So that's really all I have to say.
Yeah, no, I signed up for the Maryland chapter news announcements. As soon as I got it, I signed up for it. This is a very fun example. So come to that. And one of the stocks tonight, Intel, is in the top 100. Let's go to our next slide. And Richard, can you tell us about MCMC, one of the clubs that's celebrating tonight? Or no, I'm sorry, this is the Maryland Model Club. I'll take this. This is the Maryland chapter stuff. So the Maryland Model Club started in 2015. They have 8 partners. They meet on the second Saturday of the month. Normally they'd be meeting at the Savage Library, but they're on GoToMeeting. You can be able to click on that link to go there. And they still, when I talked with Kent last night, we don't have education or stock study set up, but you can be able to go to the web address there or reach out to the point of contact there at the Maryland chapter, and they'll get that information to you. Let's go to the next slide. And Rudy, can you tell us about your club that's celebrating 20 years at the club anniversary on Saturday?
Yeah, actually, it's a 25-year anniversary.
25, I stand corrected. Thank you.
Yes, and we're seeking new members, by the way. We focus heavily on education. In addition to the meeting on the second Saturday, we have small breakout groups that meet once a month to focus on the education topics. We meet virtually, as the slide says, and we welcome visitors. And this month's topic is understanding the flow of economies and cycles. And coincidentally, the stock to study is one that we're looking at tonight as well.
Thank you. Thank you, Rudy. All right, now it's you, Richard. Tell us all about your club.
Sure. I'm the vice president of the Montgomery County Model Investment Club. It was started in 2017, and we currently have 9 partners. It meets on the 3rd Wednesday of every month at the Rockville Library. We're also meeting in GoToMeeting since COVID hit. Our education this month will be back to basics, understanding the business cycle. The stock study will be EPAM systems, and we welcome visitors.
Thank you. Let's go to our next slide. And Cheryl, tell us all about your club.
All right, McNova has been around since 2018. We have 11 partners currently, and we meet on the second Tuesday in the month. So the next meeting is May the 10th from 7 to 9 p.m. We are meeting virtually at this point in time, but we will have a couple of meetings this year that will be over at the Tyson's Pimmet Library. The education this month is stock watching tips from our top resource holders of Value Line, Morningstar, and CFRA. And the stock that we're studying is Generac Holdings. And all visitors are definitely welcomed.
Thank you. Let's go to our, tell us about Visit a Club for both chapters.
Sure. Both chapters that have clubs that are currently looking for members, they send in their application and they get posted to this website so that people who are looking to join a club can click on and see if you're in their area and come and visit and see what you're all about. We also have a deal where you can contact either myself or some other directors of either the DC or the Maryland chapters and have us come out and visit with your club either virtually or in person, give a talk, a presentation, whatever your club would be interested in. And we would love to do that, and it benefits your club as well as the chapter. And that's all I've got.
Thank you. Okay. Let's so this is again called digging into the BI, and so we want to be able to tell you, here's the main page of the magazine, and most of us still read it when it comes in through via the post office, but you can also get it electronically, seen on your tablet, computer, on a smartphone. In fact, that image over on the left-hand side came from my smartphone. So if you have the app, you can be able to look at it as well. Let's go to our next slide. And so if you don't know how to get it onto any of your mobile devices, if you click on that green arrow on the left-hand side, it will walk you through the steps you need to be able to see the magazine on any kind of mobile devices. And then also the red arrow is for the any of the additional reports that are mentioned with the two featured stocks, a stock to study and undervalued feature. You can click on that and you can get additional information, and that goes for any stock that's been featured going back as long as they have information on it. So avail yourself of that. Let's go to our next slide. So when we're digging into the BI, I pulled out this fundamentals of investing column. And Sam Levine is both a CFA and a charter market technician. And he was giving some really good examples, with all this volatility that's going on, is to be able to understand some of the terms. Some of them are not necessarily fundamental long-term investing terms, but they still appear a lot in the news. And you may want to understand those things. We have some new people in one of my clubs, and they're always asking what seems like basic questions, but you have to remember we all have been there at some point. So it's good to remind ourselves of some of these points that are in there. So go ahead and take a look at that article, and then let's go to our next slide, our final slide, and then we'll do our presentations. I started putting this in. This is the investor education column, and so many things are going online now that you don't have to be there. And so I've highlighted two of them. One is the Northeast chapter is having one of the national directors, Alan Holdsworth, talk about 4 keys to a great stock portfolio, and it only costs you $10, and you go through a GoToMeeting link, so it's worth it. And then the other one that looks really good is learning how to use Value Line online. And that's going to be over 3 successive months. Unfortunately, it conflicts with my model club meeting, but it still is a very valuable thing to take a look at. And that one's free. So go ahead and sign up for those. Next slide. Okay, we're ready to be able to start doing presentations. And the first one up will be Rudy Watson, who's going to tell us all about Expeditors. So let's go to the next slide, and Rudy, take it away.
Thank you, Kevin. I became aware of Expeditors in discussions during one of our investment club meetings, and I found it in 2 stock ideal functions in the BI Stock Selection Guide tool. Next slide. From the home page under Find Great Stock, I selected First Cut Stock Reports, and the report listed for Expeditors was from March of 2022. I also selected the stock screening from that same drop-down window and clicked on the heat map. And Expeditors, which is circled in red, is listed under the industrial sector. Next slide. Expeditors International of Washington went public not long after it was founded. Its headquarters is located in Seattle, Washington. Its 18,000 employees are in offices around the world. The industry is designated as integrated freight and logistics, and recent growth has moved the company into the large size category. Next slide. So what does Expediter do? In fulfilling its mission statement, they provide a full suite of global logistics services, offering customers a seamless international network of people and integrated information systems to support the movement and strategic positioning of goods. Next slide. As a third-party logistics provider, Expeditors purchases cargo space from carriers such as airlines, ocean shipping lines, and trucking lines on a volume basis and resells that space to their customers. They don't compete for overnight courier or small parcel business, and they do not own aircraft or ships. For air freight, Expeditors typically acts either as a freight consolidator or as an agent for the airline that carries a shipment. For ocean services, Expeditors offers 3 basic services. For ocean freight consolidation, they contract with ocean shipping carriers to obtain transportation for a fixed number of containers between various points during a specified period at agreed upon rates. They then sell full or partial container loads to their customers at better rates than the customer can get directly from the carriers. They also generate fees for services such as the preparation of documentation to comply with local export and import laws. In direct ocean forwarding, it acts as the agent. When an expediter customer contracts directly with the ocean carrier, in addition to customer handling and service fees, expeditors may also receive a commission from the carrier. The last is order management, where expeditors provide services including consolidation of cargo from many suppliers in a particular origin into the fewest possible number of containers, putting more product into larger and fewer containers, maximizing space and minimizing costs. Through their technology-dependent software as a service offerings, Expediter provides a broad range of transportation services and customer solutions. Next slide. For a fee, Expeditors helps importers clear shipments through customs by preparing required documentation, calculating and paying duties and other taxes on behalf of the importer, and arranging for any required inspections by governmental agencies. They provide import services such as arranging for local pickup, storage, and delivery at destinations. Expeditors' target market are customers looking to reduce the number of custom brokers used, those looking to improve compliance and reporting, and those seeking opportunities to participate in special trade programs globally. Expediter has a project cargo unit who handles special project shipments that move via a single method or through a combination of air, ocean, or ground transportation. It generally requires a high level of specialized attention because of the unusual size or nature of what is being shipped. Expeditors' warehousing and distribution are offered globally in multi-client facilities so that customers can benefit from cost savings related to shared space, labor, equipment, and other efficiencies. Next slide. So what makes Expeditors different? Expeditors maintains a compensation structure that is unique to the logistics industry. Each of the company's branches are independent incentive-based profit centers. This compensation structure ensures an objective allocation of revenue and expense. In other words, they have a handle on where they're making money, where they're losing money, and who's responsible to address it. The other thing that stands out about Expeditors is their global technology infrastructure. Expeditors' technology platform is designed, coded, tested, and implemented internally. They consider information systems a core function that should not be outsourced to third parties. Next slide. Expeditors value their human resources as assets. It shows in the recognition they have received over time, as well as in the retention of their employees and senior leadership. Also, their culture and business model demand a focus on addressing the needs of their customers. Expeditors' success is indicated by being ranked as #2 in logistics by Transport Topics, a premier journalism and publishing organization. It is focused on freight transportation and trucking, and has been around since 1935. Next slide. Once more, Expeditors doesn't own any airplanes or ships. Having timely data and insights provided through data analytics is essential to their business model. It is so essential that it was a major deal when they were hacked in February of this year. They had to totally shut down operations for 8 days, after which they resumed partial operations. They didn't resume full operations until the end of March. I know from personal experience that their external website was not highly responsive until this past weekend. The goods that Expeditors handles are generally a function of the products that dominate international trade between any particular origin and destination. These goods include products from diverse industries. Expeditors utilizes industry vertical teams throughout their network to focus on providing tailored solutions to different industries. No single customer accounts for more than 5% of Expeditors' revenue. Next slide. These pie charts show what percentage various services contributed to the revenue of the company. What stands out to me is the relative growth of custom brokerage services and ocean freight services as compared to air freight. Next slide. This slide shows that the majority of revenue for Expediter comes from North Asia, followed by the Americas, then Europe. The pattern has been consistent over the past few years. However, notice the significantly more growth in revenue in North Asia and South Asia in 2021 as compared to 2020. Those regions doubled in revenue. Next slide. Expeditors' culture values promotion from within. This contributes to the longevity of their senior management team and to the good job they're doing in managing the business. They're extremely consistent in their pre-tax profitability and percentage earned on equity. Like many companies affected by the pandemic, they have increased their debt. However, as of the end of 2021, according to their annual report, Expeditors has no long-term debt. Next slide. Expeditors' competitive advantage is its focus on organic growth and utilization of their single enterprise technology platform, which helps them meet diverse and complex global logistics and supply chain needs. This contributed to their phenomenal growth starting prior to and continuing during the pandemic, doubling their revenue from 2018 to 2021. As shown in step 1 of analytics growth in the SSG core tool, it grew from 8 billion to over 16 billion. Next slide. Now I will describe my judgments. The inserted screenshot of estimates outlined in yellow is from Value Line. The forecasted revenue growth rate for 5 years is 7%. Since the annual growth rate has been, the average annual growth rate has been 9.2, and they've been consistent in their performance during the past, I thought it was reasonable to accept the Value Line estimate as my own. Next slide. Similarly, I chose to use the Value Line earnings per share growth rate of 10%. I felt this was being a little conservative given the average EPS growth rate of 16.5. However, there is an unknown financial impact of the February cyber attack that I believe warrants being somewhat conservative. Next slide. Value Line provided an 18-month high target price of $191 and a 5-year high of $170. I feel comfortable using the 18-month high as the 5-year high. 14.3 as a high PE gave me a high stock price of $190.05. Next slide. My final judgment is the low PE. I knew the low PE would be lower than the current PE of 12.2. It had to be lower than the current PE of 12.2 to avoid an invalid result. I also wanted my low PE to be at least 20% lower than the current price of $100.70. I chose 10 as the low PE because it gave me a low price of 82.6. Given that the 2021 low stock price was 89.3, I felt that I didn't need to go any lower. Next slide. The result was Expediter falling into the buy range at a 5.0 to 1 upside downside ratio. Next slide. So what makes me believe Expediter will achieve the growth target predicted by my judgments? Consider the fact that Expediter grew its revenue during the pandemic when the industry was having tremendous supply chain issues and that it only has 7% market share. That makes me optimistic about the opportunity available to the company. Next slide. This slide shows the growth to which I recently referred. Expediter grew revenues 21% in 2020 and 72% in 2021. Remember that this was during the pandemic. Next slide. The question is, what concrete steps are the company taking to achieve the growth? They plan to do so by ensuring that baseline strategies for air, ocean, and customs services for every district office and region lead to growth at the relevant market rates, profits, and volumes by services. Also by growing their business services into and out of Europe with particular focus on certain defined markets beyond their baseline growth expectations. They'll be continuing to leverage their long and deeply entrenched presence in China, as well as the customs brokerage as well as the reputation that they have with the strategic carriers servicing China. To build a stronger custom brokerage and in-country presence, they're going to leverage those relationships. Their main focus remains on developing and integrating their custom systems and to provide local delivery and support services in China. Finally, by growing their customs brokerage service in South Asia and in India, they will leverage their strength there and their expertise and their custom brokerage services, developing their critical talent, processes, and tools. Next slide. The company will likely expand its operations by bringing new customers on board and increasing volume with existing clients. Moreover, management has been controlling costs and reinvesting savings to upgrade technology. Expeditors earns a portion of its total revenues by acting as a customs broker, assisting importers with clearing shipments. This portion of the business has promising top-line growth potential over the long haul. And customers are becoming more global, and they're going to need help navigating the intricate customs process. Next slide. So in conclusion, Expeditors is a large, fast-growing, mature, but innovative company. They're very well managed. I believe they're on sale, trading below its 5-year average PE. To satisfy an upside-downside ratio of 3-to-1, which gives a 15% total return, Expeditors is a buy up to $103.60. And so I say that Expeditors would make a good addition to your portfolio. This concludes my presentation.
Thank you, Rudy. Very good, as always. All right, let's go to Lee Outlaw. And before we do that, a reminder, these are our judgments. Make sure to do your own and make sure to also get the handouts, including the completed SSGs from all of our presenters. Lee, over to you.
Thanks, Kevin. Good evening. I'm Lee Outlaw, a volunteer director for the DC Regional Chapter. And as stated, I'll be briefing Intel Corporation. I found it, I was in BI magazine for April as a top 100 selection. I'll be briefing using SSG Core. Intel was also one of the top 100 stocks club members have created studies on in the past 90 days. Next slide. So here's a picture of Intel on the heat map. It's circled in the oval. You'll see by the green color and the density of the color that it's received considerable recent interest and favorable impression. Next slide. So what is Intel Corporation? I show the closing price of 43.59. This is actually what it closed on the 29th of April, but my analysis was done Tuesday of last week. At that time, it closed at 47.06. Its fiscal year is consistent with the calendar year. It's founded in 1968 in California. Industry, semiconductors, sector technology. It's a large company based on sales. Intel is the world's largest chip maker. Its x86 chip drives the PC CPUs. As I said, it was founded in '68. Moore's Law, which I mentioned here, is named after one of its 3 co-founders and its first CEO. It posits that the number of transistors on integrated circuits doubles approximately every 2 years, meaning subsequent chips have substantial power, cost, size improvements. And this remains the inspiring philosophy for the corporation. Next slide. So Intel's great growth story starts with its CEO, Pat Gelsinger. Pat replaced Bob Swain as CBO of Intel in January of 21. Swain, who had a finance-oriented background, only served for 2 years as CEO. He appeared out of place to his peers at Nvidia and AMD, who were both engineers. Gelsinger, however, has a rich technical background. He was VMware CEO from 2012. He spent his first 30 years of his career at Intel. He was Intel's first chief technology officer and led 14 different microprocessor programs. The term IDM actually stands for Integrated Device Manufacturer. And his vision for the corporation is for Intel to be the premier growth engine in the semiconductor space. Its main themes going forward are to better balance chip manufacturing, which is now dominated by Taiwan, China, and South Korea, and also to advantage what is forecast to be an additional $500 billion market for semiconductor technology by the end of this decade. The squares on the right depict the focus of its 6 complementary business segments. Next slide. So this slide depicts the big business segments. You have the client computing group, which makes microprocessors and related chipsets, notebooks, netbook, and desktop segments. The data center AI group develops data center CPU products for cloud-based world programmable semiconductors. Network and Edge group focuses on delivering platforms designed for embedded market sectors, including retail, transportation, industrial buildings, and etc. The accelerated computing systems graphics focuses on key growth areas of high performance computing. Mobile, very interesting sector or segment, includes development of systems that support advanced driver assistance systems and autonomous driving. And then the Intel Foundry Services drives the expansion of the Foundry offerings. You notice on the first quarter that the emerging, well, you may not be able to add it up, but the emerging segments were only 4.9% of sales. Those are the bottom 3, the bottom row in the chart. Next slide. So I mentioned balancing the global semiconductor supply chain is the key focus. We've all heard a lot of that about that in the news. Since 1990, U.S. and European chip manufacturing capacity has dropped from 81% to 21% in 2020. And their vision, or his vision, is to get those figures up to 50% by 2030. They recently announced plans to expand or invest $80 billion, 80 in the European Union to improve their R&D and manufacturing. Countries included are Germany, France, Ireland, Italy, Poland, and Spain. And since Gilsinger took over, he's established chip foundries in Arizona, Oregon, and Ohio. And Congress and the president have gotten behind the chip manufacturing push. Next slide. So this is Intel's path to double-digit growth. They expect half of their growth to come from the emerging business sectors, seeking to reach 10 to 12% growth by 2025. Next slide. Okay, so this is another picture of the same thing. Revenues up and expenses down. Next slide. So I thought I would share a little bit of first quarter results and forward guidance. And as you can see, Intel disappointed the market. They reported their earnings on last Thursday. On Friday, Intel led the Dow down, dropping 6.94%. During the call, the CEO was very positive, gave a very positive progress report on all its segments. The CFO then said that each segment exceeded revenue, gross margin, percentage, EPS guidance, despite continued ecosystem supply chain constraints and inflationary pressures and macroeconomic uncertainty. He also said 3 of the corporate of the 6 segments exceeded their revenues. Problem, well, not really a problem, but that growth was in the emerging sectors, which are, as I said before, only 5% of the revenues reported for the quarter. So, thinking about the drop, I think the market might have been fixated on the down year over years that you see in all the categories except revenues in projected FY22 outlook. Next slide.
5 minutes, Lee.
Okay, so here briefly we see what CFR industry has to say. Shows 3 of the 4 stocks that I've evaluated. Outlook is positive. Compound annual growth rate 6 to 7%. CFR analyst has as a whole. Next slide. You'll see that semiconductors and the semiconductor equipment have really outperformed the market in recent years. However, their downturn has been ahead of the market since about the middle of last year. Next slide. So I won't go over all of these. You can read them, but you can just see on this chart that Intel is discounted by 33% based on the 29 April close. It's a wide moat, dominant CPU space, but it's got some competition from, strong competition from Taiwan Semiconductor. They plan on having Mobileye go public next year, and this should be a revenue enhancer. They also acquired Tower Semiconductor, which is Israeli chip maker, which should enhance their foundry market capture. Next. Just point out a couple things on this slide. Value line, you can see from the oval again that Intel is moving well below, as price is well below the value line. Total return on the left is projected as a low of 25%, a high of 30%. Down on the bottom highlighted is the fact that they expect total return very good in the next 3 to 5 years. However, increased costs for a drag on their operating margin. But at the last quarter of FY 21, and you saw that again for the first quarter of this year. So the growth might be slow in coming. Next slide. Looking at their sale history, Intel was significantly outperformed the industry and peer group averages. Next slide. Same applies on this slide. They're ahead of the peers and industry group averages. However, a little behind with NVIDIA, Advanced Micro Device, and Taiwan Semiconductors. Next slide. Okay, on this slide, pre-tax profits, Intel's in the ballpark with competitors and industry group. Return on equity trails all the categories shown, their peers and the industry average and peer group. And debt to equity, I consider Intel to be in line. What stands out is at least on this chart, is Taiwan Semiconductors low debt. Next slide. Here are the analyst details I received pretty much all over the map. On this one for sales, what I generally do is I project sales to match, or sales percentage to match the sales growth figure on the right. And then as far as EPS growth, I pretty much hit it in the middle. Next slide.
2 minutes.
Okay, so given that, I used 2.1 for sales growth, which basically matches the value lines, 88.5 billion estimate. That next slide. EPS growth, basically what I used here was the preferred procedure, 5%, which was the mid-range of the analyst estimates. Next slide. On this slide, using the 5-year average PE, I came up with a high price of 96.7. Next slide. Low price, eliminating 2017. Came up with basically what I did on this slide was use 20% of the close on the 25th of April, which gave me a low price of 37.6. Next slide. So here is kind of the wrap up based on the analysis. Intel is a go, a buy up to 52.4 with the upside downside ratio of 53.1. Compound annual return using high PE of 17%. Let's see. The PE or the projected annual return using the average PE is 12.3. And just for grins, I did a quick analysis to see what the upside downside ratio would be given Friday's close. Keeping the low price the same, I came up with an upside downside ratio of 9.8 to 1. Lowering the low price to 80% of the close, I came up with an upside down side ratio of 6.7 to 1. Next slide. So here are my conclusions. Intel is a large size, modest growth stock that's well managed. Current PE indicates that it's underpriced. It's trading below its 5-year low PE average. And as I mentioned, I see it as a buy up to 52.40, 3.1 upside downside ratio, 15% total return. I see as a worthy candidate for purchase consideration. However, you might be patient just to see how things go in the near term. And that does it for me, Kevin.
Thank you, Lee. All right, and so now we're going to hear from Richard and hear about Alphabet. And again, as always, make sure to do your own research. But Richard, take it away and tell us about Alphabet in using SSG Plus.
Okay, so tonight I'm going to be presenting Alphabet. It's listed on the NASDAQ exchange under two symbols, GOOG and GOOGL. It was a stock to study in the BI magazine in the May 2022 issue, and also listed in the top 100 number 4 in the Better Investing April 2022 magazine. Next slide. Just a little bit more information. As I mentioned, there are two ticker symbols, GOOGL and GOOG. GOOGL is a Class A voting shares, and GOOG are Class C non-voting shares. They track each other very closely. Usually GOOG is slightly discounted to GOOGL because of non-voting. And if there are any founders or insiders listening in tonight, they can buy Class B stock. Industry is internet content and information. The sector is communication services. Super sector is sensitive, and the company is large, 258 billion in sales. Next slide. I thought I'd start with a little trivia before we jump into the fun stuff. Alphabet was formerly known as Google, and the Google was supposedly an incorrect spelling of the mathematical term Google, which was the term was coined in 1920 by a 9-year-old nephew of a mathematician. So what's a Google? A Google is defined as 10 to the 100th power, or 1 followed by 100 zeros. And just to add to the trivia is a Googleplex, which is 10 to the Google, or 10 to the power of 1 followed by 100 zeros. So enough of the trivia. Let's jump into the analysis. So as I mentioned, I found Alphabet in a stock to study in the Better Investing magazine. It was also featured in a number of other editions dating back to 2011. Next stock, please. Next slide. So what business is Alphabet in? Founders Larry and Sergey wrote in the original founders letter that Google is not a conventional company and they do not intend it to become one. It's actually a collection of businesses, a holding company, if you will, the largest of which is Google. Google reports in 2 segments, Google Services and Google Cloud. All other non-Google businesses are known as other bets. That's what they call it. And they include very early stage technologies such as self-driving cars, artificial intelligence, and quantum computing. Next slide. Google Services is a primary source of revenue and generated $237.5 billion in 2021. And the total revenues that year were $257 billion, so it's 92% of total revenues. That gets broken down into Google automatic and targeted digital advertising based on the Google search engine and other channels, which amounted to $209 billion in sales, or 82% of revenue. Other Google services include Gmail, Google Maps, YouTube, Google Chrome, Google Photos for $28 billion, or 11% of sales. The other segment, Google Cloud, generated $13 billion in revenue, or 7% of total revenue. Next slide. The market share, search engine for Google is a near monopoly with 88% of the online search engine market Microsoft Bing is a very distant second, followed by Yahoo, and China bans Google. Baidu controls 80% of the search market in China. Google Entertainment, otherwise known as YouTube, brought in $17 billion in revenue in 2020 and grew 30% year over year. So it's a growth element in their business. They compete against the basic streamers, Netflix, Hulu, Disney, Apple, and other streamers. And Google YouTube also competes for people from other social media, Meta, otherwise known as Facebook, Instagram, Twitter, TikTok. Google Cloud, on the other hand, was late to the game compared to Amazon and Microsoft, and holds a very small share. Next slide, please. So Google Cloud captured 10% of the $178 billion cloud services market. Cloud services market grew 37% in 2020 to 2021, so it's growing quite rapidly. But it's dominated by Amazon Web Services and Microsoft Azure, with 54% of the market. But Google Cloud can grow from a larger pie, which is growing quite quickly, and also a bigger piece of the pie by expanding their capabilities with a recent acquisition of Mandiant, which we'll talk about shortly. Next slide. The other bets encompasses initiatives outside of Google segments. In 2021, that segment generated only $657 million, less than 1% of the total. And these are high risk, high potential returns endeavors: driverless cars, fiber optics, Internet of Things for smart home market, health sciences company, and a fitness tracker. And as I mentioned, in March of 2022, Alphabet acquired Mandiant, which specializes in cloud cybersecurity services, giving them much more capability compared to Amazon and Microsoft Cloud. Next slide. So in summary, Alphabet makes money by selling advertising on their Google search engine, YouTube, and other endeavors, amounting to 93% of their revenues. Google Cloud adds another 7%, and other bets are just less than 1%, and are long-term high-risk investments. Next slide. Moving into the stock selection guide analysis. Next slide. So I looked at several analysts' comments. Value Line rated Alphabet 1 for safety, 1 for timeliness, and A++ for financial strength. Doesn't get much better. They estimate that Alpha's revenues and earnings will advance 12% and 10% respectively in 2022. And you'll see that in the spreadsheet coming up that is part of my judgment for sales and earnings. The balance sheet is in good shape. Debt to capital was 10.1% in 2021, down from 10.7% in 2020. Morningstar liked the acquisition of Mandiant, which will help Google compete with Amazon and Microsoft, and they expect continuing growth in the firm's cash flow. They foresee YouTube contributing more to the firm's top and bottom lines. And they think Google will continue to grow at double-digit rates after the pandemic and during the next 5 years. Morningstar rated Google at a 29% discount as of valuation on February 2nd, 2022, and has a wide moat. Next slide, please. CFRA rated Alphabet a solid five-star buy condition. Revenue increase, they project revenue to increase 17% in 2022 and 16% in 2023, after a large rise of 41% in 2021. And they believe that that trend will continue growing as the global shift to ad spending for digital online search and YouTube videos. They see revenues increasing in the mid-teen growth, which I'll interpret as 15% for now. Two other growth contributors which are adding is YouTube, which was up quite nicely in the fourth quarter of 21, and followed by Google Cloud, which was also up quite nicely in 21, and they expect it to grow 30% per year through 2023. They expect one moonshot to contribute materially to the sales by 2024. I didn't take that into account as I felt it was a long shot and it would just be an added bonus if it happened. CFRA's strong buy reflects a view of valuation versus other large cap tech peers. Its free cash flow and belief that Google can sustain mid-teen annual growth, continue its annual growth pace. Next slide. So this is the front side of SSG Plus. Sales, pre-tax profit, and earnings are pretty much up straight in parallel. Sales have consistently grown at 19%. Free cash flow has been trending upward with no major setbacks for the last 10 years. Earnings are growing at 21%, and sales nearly doubled in 2021. Management is doing an excellent job as well. Pre-tax profit on sales is growing at 27%, 35% last year. Return on equity growing at 18%, 30% in 2021. And debt to capital, as I mentioned, was 10.1% in 2021. The arrow should point to the stock is in the mid-range between its high and low for this year so far. And so we can expect a positive thing coming. Next slide, please. So I created a spreadsheet of projections from the analysts of what the stock compound annual growth rate would be for the next 5 years. And I listed several of them that I found were able to collect and computed the average, which has turned out to be 17.6%, and looked at the spread basically from a low of 15.6 to a high of 20. And selected the average, slightly above average based on the comments that I read. So I chose as the judgment for sales growth rate 18%. And that compares to Value Line's estimated growth in the 2024-2026 timeframe of 18.5%. Next slide, please. I ran a spreadsheet for the earnings projection using the same analysts that I had available to me. And I also included preferred procedure. The average came out to be 22.1, and the spread again was between 25% and roughly 20%. I decided to go with preferred procedure based on some modified parameters using Value Line data. Next slide. So I adjusted the pre-tax profit from 27% to 36% based on the income tax rate that Value Line projected and the net profit margin of 31.5% that they project as well. Combine that with the share buyback, which is the blue line in this small version of the front side of the stock selection guide. There's been a downward trend in the share buyback, so they're expecting 660 million shares available. That resulted in a 20.2% earnings growth rate. Next slide, please.
4 minutes, Richard.
Okay, the high PE, I deleted the 2017 data as outliers, and the average high came in at 28.9. The current PE as of April 19th was 23.2, and the average price earnings ratio was 23.9. Based on that and the fact that Value Line and CFRA projected an average PE of 25 over the same time frame, I selected a high PE of 26, slightly above the average. Next slide, please. The low PE I selected, average was 18.9, and I noticed a downtrend in the low PE from 22 down to 15. So I decided to choose a low PE of 13 for the 5-year time frame. Next slide, please. So the high price is 7,038 based on a PE of 26 times 26 earnings of $281. Low price is 1459 based on a PE of 13 times the 21 earnings of $112. The low price was 43% the then current price of 2,600 on April 19th, 33% below the low of this year and 14% below the low of 2021. The average low for the last 5 years was 1,000. So I felt very comfortable with the low price, and the high price seemed a little high, but those were my judgments. Next slide, please. The upside to downside ratio came out to be 3.9 to 1. The total return with the high P is 22, the average P is 15.5. And the stock is in the buy zone up to a price of $2,854. Next slide, please. I did update the SSG with the first quarter 22 financial results, and they were in line with estimates. Sales were up 1.3%, but earnings were down 6.8%, mostly due to higher costs. Advertising revenue continued to be improved at 22%. YouTube revenue grew 14%, slowing a little bit from 21 due to increased competition, and the cloud business grew 43%, giving me hope that the cloud business can add materially to the revenues and sale and earnings. That increased the upside downside ratio to 5.6 to 1 and a potential return of 25%. Next slide, please. In summary, Alphabet is a large internet content and information company selling advertisements. Its strength lies in its 80+% worldwide share of search engine market, and that powers its advertising revenue. Its potential growth in the cloud services and YouTube advertising adds to its future growth potential. It has lots of competition in all its business areas, but it dominates the advertising market through its search engine. Risk reward ratio is 5.6 to 1. Total return is currently 26%. They announced a stock split of 20 to 1 for July 15th, 2022, putting it in the price range of many smaller investors. And I'd recommend Google as a candidate for your portfolio at a price below $28.54. Thank you.
Thank you very much. And last but certainly not least, Kenneth Williams, you're going to tell us about H&R Block, so take it away.
Hi, everyone. My name is Kenneth Williams. I'm a DC Regional Chapter Director. I'm also a member of the MCMC Model Investment Club, and I have been an H&R Block tax professional for the past 23 tax seasons. Next slide. This stock was selected as the Better Investing Undervalued feature. It's featured on page 28 of the May issue of the magazine. Next slide. I wanted to start off by getting some insight as to why this stock was selected as undervalued feature. Keep in mind, at the time of selection back in March, the price of the stock was $25.64. If more taxpayers could turn to Block in frustration, the company would see a one-time boost in its results, noted members of the Editorial Advisory and Securities Review Committee. A surge in customer demand and combined with Block's perceived undervaluation could spark more investor interest. That could help ease the stock toward the undervalued company goal of a 20% return increase within 18 to 24 months. In addition to operating a network of brick and mortar outlets, Block offers tools for do-it-yourself tax filing. It competes with the leading providers of tax preparation and digital payment products, such as PayPal, Intuit, the distributor of TurboTax, and Block, formerly known as Square, and a company that the company has a suit with because of the name. Committee members noted, however, that the digital competition is no doubt already priced into the stock. They say Block has a strong position in its niche, catering to individuals and small business owners who find tax filing well taxing. Next slide. Okay, so the company provides help with and inspires confidence in clients and communities through the global tax preparation, financial services, and small business solutions. They're a leading assisted and do-it-yourself tax software provider with nearly 10,000 locations and a 13% market share. They operate under H&R Block, Block Advisors, Wave, which is a recent acquisition for software for small businesses. And finally, Spruce Brands, which is their attempt to get into the fintech craze right now. Also, want to make you aware that they do own TaxCut, which is another do-it-yourself software option. Next slide. The company has founded the tax industry and has completed the 68 tax season. Though it is the largest assisted tax preparer in the United States with 15% with a 15% market share. Has unmatched scale. A vast majority of Americans are within 5 miles of an H&R Block office, and approximately 10,000 offices across the United States. 2/3 of the locations are company-owned, and about 1/3 are franchised. The ability to quickly scale up and down to optimize its network footprint is another advantage of the company. Next slide. H&R Block generates nearly as much revenue as all its assisted and do-it-yourself branded competition. So in the assisted market, which is a $20 billion market, they have about a 13% market share. And then looking at overall revenue by competitor, they have about 14% of the market there. It's largely dominated by independents and CPAs, individual CPA offices. Next slide. Approximately 80,000 highly trained U.S. they have approximately 80,000 highly trained U.S. tax professionals. The professionals complete about 39 hours of training annually, and there are over 7,500 enrolled agents. Enrolled agents are tax professionals that are licensed by the IRS to represent taxpayers before the IRS and CPAs. The average tax professional has about 10.5 years of experience or tenure with the company. Next slide. All right, so for clients of H&R Block, there are a number of products that are available to them. First is the H&R Block Emerald Advance. It's a pre-season line of credit up to $1,000. They tend to fund about $400 million in loans each year, and it generates about $57 million in revenue. Another product that they offer is the Refund Advance. It's an interest-free, no-fee loan up to $3,000. They process about 1.2 million applications a year, and 1.1 billion in funded loans. The loans are funded onto what's called an Emerald Card, and that's their next product. The Emerald Card is the third largest general purpose reloadable debit card in the United States. It has about $9.5 billion in deposits. This product generates about $103 million in revenue for the company, or about $52 per card. Then there's the Refund Transfer product. It allows the client to pay nothing out of pocket for their tax preparation. Has a very high attach rates of about 4.6 million total units, and it generates about $172 million for the company. The next product is called Peace of Mind. It's an extended service plan that's available to each client. It includes IRS representation. The attach rate is about 9 points in 5 years to 29%. And then finally, we have Tax Identity Shield. It provides protection against identity theft. Additional service can include a dark web scan. We sell about 1.3 million units a year. Next slide. The company has a long track record of acquiring franchises. They acquire approximately 125 locations annually. H&R Block purchased CPA practices of owners who either retire or desire to sell their practice in order to obtain client lists or new store locations. Next slide. Okay, and then we have Wave, which is one of their more recent acquisitions. It was acquired in 2019. it offers very good growth, but when you factor it into the overall growth of the company, it's less than 1 point of growth annually. Next slide. So going forward, how will the company make money? The next phase of the strategic growth is this Block Horizons program, Block Horizons 2025. So they're focusing on small business, build direct, valuable relationships with small companies and owners through Block Advisors and Wave. They're offering financial products. In January 22, they launched the Spruce, which is their venture into fintech and providing a mobile banking solution. And finally, we have the Block Experience. They're making tax preparation easier, faster, more personalized by blending digital tools with human expertise and care. So the additional initiatives here are either less than 1% or 1 to 3%, at least for the pricing product. Next slide. So taking a look at the value line, we see we have a PE of 7.7, which is going to remain relatively flat over the next 3 to 5 years. That's 7. If you look in the bottom right-hand column, it does offer a 3.9% dividend yield. Looking at the graph at the center of the screen, you'll see that it's trading slightly above the cash flow line, indicating that it's slightly overvalued. And then looking at the projections going out to for the next 3 to 5 years, you got an interesting return range of 6 to 16%. Also looking toward the bottom of the right-hand side of the screen, we see that the net profit margin is expecting to decrease to 17.9 from 19.2. And the company has been reducing its debt, going down to 1.7 billion in 3 to 5 years. Next slide. Okay, so taking a little brief review here of CFRA and Morningstar. It is a quantitative buy according to CFRA. You can see the various metrics there. They seem to be positive for growth and street sentiment according to CFRA, based on their quantitative model drivers. And then looking at Morningstar, their fair value of the company is $25.91. It closed this past Friday at $26.07. So it's trading a bit above fair value. And they assess the economic moat as narrow. Next slide.
4 minutes, Ken.
Okay. This is a tool that I like to use. It's called Simply Dividends. And looking at how H&R Block's dividend is rated for safety, they have a score of 57. Essentially means that it's a moderate risk of a dividend cut over the next economic cycle. And then the dividend growth, they essentially have paid a dividend consistently over the past 23 years. 3.8% in the past year, 5% over the last 5 years, 7% over the last 20 years. Next slide. Okay, so looking at the front side of the SSG, it's fairly up straight and parallel with a major dip here in 2019. The dip is as a result of the Wave acquisition and the Tax Cuts and Jobs Act that was passed in 2018. As a tax professional, we like major changes in tax law. Major changes in tax law create confusion, and the resulting confusion brings more clients into the tax office. H&R Block charges for tax preparation by tax form. The implementation of the Tax Cuts and Jobs Act resulted in less revenue from IRS forms such as Schedule A, Form 2106, Employee Business Expenses, and Form 8829, Business Use of Home, as many taxpayers could not itemize due to the elimination of filing exemptions, the state and local tax limitation or the SALT limitation, and the increase in the standard deduction. These changes dramatically impacted revenue that year. Next slide. Okay, so I derived my judgment of 11% from the 5-year sales growth from value line. And then the 5-year EPS estimate is derived from the long-term estimate of 12.5% indicated by analyst consensus long-term estimate. Next slide. And then reviewing management, pre-tax profit is above the 5-year average, and debt to capital is trending down. You'll notice that the return on capital started going negative in 2015 due to a number of issues, including repayment of interest on maturing notes, failed business acquisitions, or businesses that they had to get rid of, or expenses from the sale of previous acquisition. Next slide. I eliminated the 2019 high and low PEs and the 2019 payout ratios as outliers. This resulted in an average PE range of 8.1 to 11.2 and a 5-year payout ratio of 39.3%. Next slide. Looking at the risk judgments, I used the Section 3 averages for the high and low PEs, and I selected the 4BEA low price of 1570 as my low price. This results in an upside downside ratio of 1.3 to 1 with the current with the current price in the hold zone. Next slide. So the 5-year total return is in the range of 9.4 to 12%. And finally, next slide. So here's my conclusion. The company is a medium-sized, moderate growth company. Fairly well managed. It's overvalued BI magazine undervalued feature, in my opinion. It is trading above its 5-year average PE. I believe it is a hold at the current price of 2607, at least the price as of this past Friday. And I think it's a rather interesting stock study.
Thank you, Ken. And thanks to all of our presenters. So we're going to do a little recap here. So there are the 4 stocks again that we looked at. Let's go to our next slide. And what we do is we tend to look at the T. Rowe Price's life cycle of a company and sort of ask our presenters to be able to tell us a little bit about where they think it sort of fits in there. And let's go to the next slide. It's easier to explain visually. And why don't we start, Rudy, if you can unmute yourself and tell us why you sort of selected that location for Expeditors.
Well, I thought that they did recently experience explosive growth, being that they went from, I think it was 2018 or 19 at 8 billion to 16 billion in 2021. But I don't see them being able to replicate that. So I think they moved out of the explosive growth stage and are moving into the more mature growth and also they now are a large company, and I think the growth will reflect that. So that's why I placed them there. Okay, thank you. Lee, tell us about why you put Intel sort of over there towards the end of mature growth.
Well, I still consider it a mature company with continuing growth potential, but kind of at a more moderate pace. I don't see explosive growth, and I don't see it hitting the stabilization point yet, given all the initiatives that they're working right now to plus up their growth.
Okay, thanks. Richard, tell us about Google and Google L and why you put it there.
Well, normally I'd put a company such as Google in the probably mature growth stage, but Google, for its size, still has 18% growth rate estimates going forward. So I still think it's in the explosive growth area of the life cycle.
Very good, thank you. And Ken, you have H&R Block outside. Tell us why.
Well, the company was started in 1946, and it's a medium-sized company. After all those years in business, it has not achieved revenue to such an extent that it can be called a large company. And the company is offering very modest growth goals in the future. So they're really desperate to grow their revenue in some form of fashion, and they tried to do that through a number of different acquisitions that just haven't worked well into the business. So it's on the verge of either stabilizing or declining.
Okay.
Depending on how well these future acquisitions go.
Very good. Thank you. All right, let's go to the next slide. And I think it's now time, Cheryl, to have our audience actually vote and select which one you'd like to do for further study. Not necessarily the one you want to buy, but the one that intrigues you enough to do some more study. So put up that, and everyone gets a chance to vote who's not a panelist. And we hope you participate in that. Okay, we're collecting. We got about, we can do a little bit. Let's see if we get over 50%. Yeah, we're over 50. Can we go a little bit higher? I feel like an auctioneer. Okay, we're pushing up to about 70%. Any more? Yeah. Take one more shot. Okay. 3, 2, 1. Go ahead and close it out. And share it so everyone can see what we all decided on. There you go. Expeditors. Followed by Google. Look at that. Ken, you gave such a negative view of H&R Block, no one even went for it. Anyway, let's go on, and we'll tell some of the future things that are coming on up here. Let's go to our next slide. So yeah, if you want to do, if you like what you saw here, please join us. We have, there's information with Better Investing, so please share this with people that aren't in the Better Investing community. There is information that can be able to help them. Let's go to our next slide. And again, a reminder, all of us are volunteers. And if you want to be able to help out either in the Maryland or in the DC regional chapter, please reach out. You can learn new skills. You get to hang out with folks like us, and we like to talk about this stuff. And it becomes a nice little community. So if you enjoy it, please hang around with us and let us know. So let's go to our next slide. And if we went too fast for all of this, I gave people a little bit more time. We do have a YouTube page. So go to the YouTube page and you can watch this at any time. You won't be able to get the handouts, but you will be able to see all the slide presentations. I think we have them going back to like December or so. But that's a hyperlink up at the top, or just look for it under Digging into the BI in the YouTube search window. And go ahead and subscribe to it. Let's see if we can get up over 25 subscribers next month. Next slide. So again, we're a learn by doing organization. So these are our judgments and not to be taken as a gospel. Again, if you're not a BI member, if you want to be able to share it with something, there's a link to a free subscription for 90 days and help them become a better investor. Let's go to our next slide. If you have any questions, you can be able to reach out to either the Maryland chapter or the DC chapter at either one of those two addresses. Pretty straightforward. And finally, let's show them what we're going to be doing next month, and then we'll open it up for questions. So next month, we're looking at Adobe, LKQ, EPAM, and T. Rowe Price. And Jonathan, do you want to sort of check to see how people are doing with either questions or raising their hands and sort of shepherd that part of it? Can you do that for us?
Sure, absolutely. I don't see any questions at this point.
I just think I saw someone put their hand up for, or put their hand up on a question.
Okay, all right, let me investigate it.
So Anitra is saying, when you said this year, I mean, now, let's see. Okay, that must have been during A little hard to tell. I can't really tell on that one. So let's sort of leave that one. Anitra, if you want to, what I can do is I can unmute you. And so go ahead and unmute yourself. And if you have a question or if you want to clarify that, go ahead.
It was answered. No, I'm fine. It was answered. I just didn't know why it said final. I do know that it sometimes some of the webinars stop for the summer for something to do with from May to August. And I thought that there was a reason it said final other than the fact that I just wasn't sure. So answered, and I'm very appreciative. Thank you.
Sure. Okay. Do we have any other questions? Looks kind of quiet crowd tonight, Jonathan. I don't see too many people asking.
Yeah, I don't see any. Yeah, I don't see any additional questions at this time.
If anyone wants to raise their hand with the icon, or we can unmute you. Other than that, if everyone's quiet, we'll let you all go. This is really easy. Any parting thoughts from any of our panelists? I guess not.
Thanks for the opportunity.
Very good. Thank you, Rudy. All right. Well, with that, since we had no questions, we'll let you all go. And please join us next month when we have those stocks. And please check out the Maryland chapter event on the top, analyzing the top 100. That's a very popular one at the end of this month. And come join us on Saturday for the Club Appreciation Day in the DC chapter. 2 of the clubs that were here, in fact, 3 of our presenters are part of those clubs. So thank you to all of them, and look forward to seeing you next month. Good night, all.
Good luck. Thanks again, Kevin.
Always good to have you, Lee.
Good night, all.
Noche, Cyril.